start of this year, the prevailing mood in the oil market was not just one of doom and gloom, but of catastrophe, as the oil price sunk below $30, skidding by the middle of February to virtually touch $25, a period during which many prominent analysts and investment banks such as Goldman Sachs, all of whom were bearish on the prospects for oil price this year, even suggesting that the oil price could sink to as low as $10, i.e. Standard Chartered, which meant that the oil producers, frackers, and even a string of nations such as Russia, Nigeria, and Venezuela were on the fast track towards going bust as the oil profits that finance state spending budget deficits evaporated. Well, now 7 months on, and the oil market has gradually transformed itself from an imminent collapse to $10 to one to one of hopeful recovery, as the oil price has clawed its way back relentlessly through a series of critical levels of first $30, then $35, $40, popping above $50 to a high of near $52, more than doubling from its 2016 low, at which point all those who failed to see this rally coming began forecasting higher prices. I.e., one of the biggest oil bears of the year, Goldman Sachs, reckoned that the oil supply glut has evaporated and that oil prices are going to reach $51 at about the time when crude oil was virtually hitting the supposed forecast for 2016. These are the same fools who have been banging the drums all year for a sub $20 oil price, but then after the oil price doubled were proclaiming themselves as being bullish. This illustrates an important point. Goldman Sachs and the rest are nothing more than salesmen. They clearly don't rely on their forecast when trading, as you and I understand trading to be, for if they did, they would be back to being just as bankrupt as they were during the financial crises. In terms of my oil price forecast for 2016, my in-depth analysis of mid-January forecast expectations for the crude oil price to bottom by early February at approximately $25, with the actual bottom coming in at $26, and within the time frame for a final bear market bottom, as this video analysis illustrates. The overall picture being painted by this analysis is expectations for 3 trading ranges that would act to step the crude oil price higher during 2016. For instance, the current bottoming range, followed by a second retesting range, and then the third breakout range. Therefore, my forecast conclusion is for the crude oil price to trade within 3 distinct trading ranges for 2016 of $20 to $40, $35 to $50, and $62 to $40. Furthermore, the trend pattern imposed onto the trading ranges implies that a bottom is likely by early February 2016 at around $25, followed by a trend higher into mid-year towards $50, correction into September, and then followed by a trend towards $62 before succumbing to a correction during December, to target an end-year price of approximately $48, as illustrated by the graph. The bottom line is that the current oil price collapse is a wake-up call to all major oil producers that crude oil as an energy source is running out of time. So whilst there may be future oil price spikes, however, the long-term trend, given the likes of climate change, is for the oil age to go the same way as the previous ages, such as the Stone Age and the Bronze Age and the Iron Age. So it will be for the oil age, which means nations such as Saudi Arabia, regardless of price, understand that they need to get as much as their oil out of the ground as possible and sold off before they run out of customers. The crude oil price rallied from the mid-February low of $26, trending higher all the way towards setting a high for 2016 at $52 in early June, before succumbing to its most recent correction to $39. This is set against my crude oil price trend forecast of mid-January that forecast the oil price by mid-September should be at $45 after correcting to an August low of $39, so virtually showing no deviation against my forecast. Whilst my last oil update of mid-May 2016 confirmed expectations for the oil price to correct during the summer from the then high price of $48, which subsequently came to pass. Therefore, crude oil continues to show little deviation from the forecast trend, which is now into its 9th month, which thus implies that the oil price rally should continue by targeting a trend to a high of $60 during November before correcting during December. Crude oil analysis fundamentals. The major oil producers have failed to agree an output cut or freeze, which is oil price negative, whilst the oil industry continues to cut back on exploration, which is long-term positive for oil prices. The IEA reports, or rather forecasts, that the oil glut is expected to continue well into 2017, as well as downgraded demand growth. So on balance, there's not been as much supply destruction as there should have been, which implies a weaker oil price trend. Trend analysis. The oil price is in a trading range pending a breakout. A downside break will be at $42 and on the upside about $48. As the overriding trend is up, then the breakout should be to the upside, a resolution of which should take place within the next week or so, with confirmation on break above $49.50, whilst to the downside next support would be around $39. MACD is fairly neutral, which implies the resulting trend could persist for several months. Elliott waves. The simplest pattern resolves to the $39 low being a wave 4 low, which implies we should now be in the early stages of an impulse wave 5 that will be somewhere between wave 3 and wave 5 in terms of expectations, or $14 to $15, which would extend to a high of between $53 to $57. Seasonal analysis. Oil prices tend to rise during September, then fall into December, followed by a late December spike. So basically the opposite of my trend forecast. Overall, the oil price continues to exhibit an inverse relationship to the US dollar, which means not to expect any significant spike in the oil price anytime soon. The USD continues to trade within a relatively tight range of $94 to $100. However, immediate trend is upwards, which implies immediate oil price weakness. Therefore, clearly for the oil price trend to resume, then USD needs to fail to break higher beyond immediate resistance at 96. Else it's going to be tough to get the oil price rally going. So the overall picture being painted is one of future oil price weakness relative to my trend forecast, with the potential for the oil price to break lower and waste some time around $40 before rallying. So whilst there's been no significant deviation to date, going forward the oil price will likely find it tougher going over the next couple of months than I originally concluded way back in January. Therefore, I expect the oil price to now target a slightly lower high for 2016 of $55, which is against my January forecast high of $60. My next in-depth video analysis will seek to update the prospects for the stock market for the remainder of 2016, so do ensure you are subscribed to this YouTube channel for notification of.